What's up, guys? I thought I'd make a video now that we've got the basics on how to invest about options, particularly about credit spreads or vertical spreads, as they're known, right? I I want to share some of my experiences and let you know what really happens during a credit spread, so that if you do decide to invest in them, you can be prepared for what can happen, right? So around 2, 3 years ago, I started investing heavily in credit spreads, and they're very appealing because you have the opportunity of making a lot of money with not a lot of capital, right? For example, let's look at AMD, right? AMD is a pretty good stock. It has high implied volatility, as you can see here on the left. Implied volatility simply means um, that it's a stock that has a lot of movement, right? It can go up, it can go down by a lot, as compared to something like Apple that only has 40%, which is significantly lower, but it's a more stable company, like less ups and downs. But with AMD, you have the opportunity to make more money, right? Because of the same reason, because of the ups and downs. So everything is a trade-off. So if you look at a company like AMD, right? We talked about this in the last video. You can see any of these moving averages can act as support. The Bollinger Band can act as support. So let's say that when it was riding high, when things were good around 140s, in the 140s, you said, I'm going to place a credit spread of 120, and it would look like this, right? So I'm going to do one here. Let's say you chose a month out, which is a typical duration, right? So you're going to go February 25th. As a rule of thumb, you typically want to have a delta of 20, which is the probability that it'll actually happen. So between 20 and 20, 18 and 25, I'll be conservative and I'll go with the 18. You right click, hit sell, vertical, and you get the spread, right? So what this means, and you're going to see when I hit confirm and send, right? I'm basically selling a 90 put and I'm buying an 85 put for protection. What does that mean for protection? So as you guys know, a put is the option to sell, right? So if you're buying a put, you're betting that the stock is going down. If you're selling a put, you're betting that the stock is either staying flat or going up. So since I'm bullish on AMD, I'm hoping that it stays flat or goes down. But what happens if it goes below 90? If it goes below 90, then I am obligated, because I'm selling, I'm the seller of the option. I am obligated to buy. I'm obligated to buy from the person who bought the option, AMD at a $90 strike point. That means I'm buying 100 shares at $90 each, right? So if it goes to 60, I still have to buy it at 90. But if it goes to 100, that person's not going to exercise their option because it wouldn't make sense for them to pay less, you know? So, all right, an 85 serves as protection. What does protection mean? It means that if it goes between 90 and 85, I'm going to be obligated to buy. But if it goes below 85, I have this 85 put, which is going to cancel out the 91. And it's going to look something like this, right? So the most I can make is $84. The max I can lose is 416 because it's the 500, the difference between the 90 and the 85, minus the 84 from the profit. It's going to cost me $1.50 each for each contract. And I need this amount of capital, right, to be able to invest. It's going to have $417. So now I want to show you what it looks like in here. I've analyzed the trade. I'm going to go to risk profile. I'm going to minimize this. I'm going to move my face. All right. So you see the blue line. The blue line is how much I can make, and it's capped. It's capped at $84, right? as long as the price of AMD is above 90 at expiration. But what happens if it's below 90, right? This is where my protection comes in, right? If you look here, this is where my protection comes in. At 85, right? If it goes below 90, I'm progressively losing and losing more money. But at 85, the put that I purchased, the put that I purchased is going to prevent me from losing anymore. So even if it goes to zero, the most I'm going to lose is right here, 417. The appeal, right, is that you could see that the odds are on my side. If I go here and I go to break even at the date of expiration, it is very, very likely that AMD is going to be above $90, and then I'm going to keep the 83, right? Very likely, very nice, perfect. But here's the problem. Let's say I execute. Now would be actually a really good time to get into spreads, right? Because the market's really low, the chances of it going even lower is slim. But here's the problem. If I do a few of these trades, right, and I win, I'm winning $83, $83, $83, and that's great, right? And that's what happened with me. I was fairly conservative, right? I'm not gonna lie, I did get a little greedy and I went for a higher delta and I lost money. But you can consistently make money. The problem is that when the trade goes against you, right? Let's say if I make 5 winning trades and I win $83 5 times, it only takes one loss, right, of 417 to wipe out everything that I made, everything. So that's the problem with spreads, right? Like the chances of you winning are higher, and that's great. You're going to win a lot of times, but it only takes one loss to wipe you out. And that's what happened to me. And that's why I really don't like trading spreads. What I prefer to do is simply to sell the put, right? But sell a put of a stock that I don't mind owning 100 shares of anyway. So if AMD, right, for example, if I own 100 shares of AMD at $90, that's great. That's a great price. AMD is a strong company. It's only going to go up from there. I'll gladly buy it at $90. But I don't have to worry about, oh my God, expiration's coming up. How am I going to get out of this trade? Do I have to roll it over? Am I going to lose money on the rollover? That's something that I've done before. And you can explore, but it's a headache that honestly, it's just not worth it. If it's a company that you like, just buy it. Or just roll over the put, right? It's easier to roll one put than it is to roll over a spread. A lot easier. Especially if you're doing it in a more volatile company, a smaller company that doesn't have the volume, you're going to lose money. So you're better off just doing one trade, just one selling. If you feel good about the company, selling one put, collecting the premium. And if you're assigned, just buy it, right? But keep this in mind, right? If you're going to buy it, let me X out of this. If you're going to buy it, you have to be sure. Let's go back to trade. Delete. I'm going to sell 261. Okay. You have to be sure that if you are assigned, you're able to roll it over, or before you are assigned, you're able to roll it over, or that you're okay buying 100 shares of AMD at $90, because that means you're going to have to put $9,000 up front. And while that is a lot of capital and it's a risk, I'd rather take the chance of being assigned than taking the chance of losing money on a spread. Because if I'm assigned, I buy it or I roll it over. Fine, right? Worst case scenario. Whereas if it's a spread, the worst case scenario is that I lose my complete investment. And that's really bad. And you want to avoid that. So my advice would be to stay clear from credit spreads unless you're very, very convinced that you can get out of it, or that you're very convinced, you have a lot of conviction that it's going to go in your favor. That way you don't tie up a lot of capital. But if you have a lot of conviction anyway, and you like the stock, just sell a put. And then if you're assigned, buy it. I think that's the easiest approach. So I hope that helps, and I'll see you guys in the next video.